Welcome to the Tax Services Podcast. I'm Jason Callaham, Senior Manager on the Strategic Financing Services team, where I lead our team's efforts on compliance and kind of the regulatory side of our new market tax credit transactions. Today, we're going to dive into a topic that's both kind of powerful and often misunderstood, and that's how your project can qualify for new market tax credits, kind of the program utilizing targeted populations. So NMTC deals can be very complex, especially when it comes to qualifying businesses and structuring projects that deliver that kind of double bottom line that we like to talk about of both financial returns and meaningful community impact. That's why I'm joined today by Joe Hennessee, also a senior manager on our strategic financing services team. Joe leads our efforts on Qualified Active Low-Income Community Business Consulting and deal structuring. Together, we'll unpack some of the nuances with targeted populations, share our lessons learned from our real-world experiences, and offer practical advice for navigating the challenge and opportunities that come with utilizing targeted populations. So, Joe, thanks for being here today.
Yeah, Jason, thanks for having me. Excited to get going.
Yeah, let's start with the basics. For our listeners who may be newer to the New Market Tax Credit Program, can you kind of explain what we mean by targeted populations and why they're a priority in this program?
Yeah. So let's start with the typical transaction, because that'll give us a good point of comparison. One of the first things that I, as a Qualic B consultant or project finance team member, when I'm evaluating a transaction is its address. Because for the traditional or most common new markets transactions, being located in a qualified census tract is the main and accepted route into getting into a new markets transaction. But what if you are working for a project that serves, employs, or is owned by low-income persons, but sits outside of a qualified project? And what we're seeing is that it is not uncommon to have unqualified census tracts based on the traditional new markets regulations, but are still there to serve that low income populations. And that's where a targeted populations transaction can come up, where we don't qualify based on geography, but we can qualify based on the people we either employ, the people we serve, or the people who own the organization. And so that's really where the drive and the start of targeted populations came from.
Great. Yeah. And I think that's news to some people that are maybe new to new markets, right?
Yeah.
You know, they probably have heard someone sent them a map to look at, and their project wasn't on that map, right? So that's certainly news to some people that are just getting into new markets. So, I mean, from your experience on the project side, what's kind of the biggest challenges that you see in aligning a project kind of with these new market requirements for target populations, especially when, balancing compliance in the real world needs for the project?
Yeah, I think this is an important aspect for any new markets transaction, but it's doubly important in targeted populations. And that's the idea of access to good, organized, readily accessible information. Because although a normal new markets deal still demands a lot of information, particularly on the front end when we're trying to explain the transaction, explain the impacts, we're also not fighting how we are getting qualified for new markets. But when you're in a targeted populations transaction, you want to have access to all that clean, organized information so you can understand kind of what is your route to complying, and then further on, after you close the deal, how are you going to maintain compliance later on? Also, in any new markets deal, there is still always this idea of kind of competitiveness, preparedness. Regardless of whether you're a traditional new markets deal or a targeted populations transaction, you want to put your best face forward, your best foot forward, I should say, when you're talking to your CDEs. And it's important to show that you have good organization and that you are good at keeping records, and that you are responsive to people asking for information requests, because your CDEs will ask for information, certainly during the lead up, but then they will also have regular outreach with you during the compliance period. And without good information, it might make you look unorganized if that information isn't quite accessible. It might make it look like you're not responsive in a timely manner. So having that information really well organized at the beginning can really help your case in a traditional transaction, but certainly in a targeted populations transaction. This can become a challenge because we'll walk through some of the compliance angles here in a moment. But sometimes keeping good records in new markets means updating your system. So you're asking for new information. You might be asking for information from your clients or your employees that they're not used to you requesting before. So you want to think through the strategic way of working with your partners, whether those are internal or external partners, on how to collect that information and how to make sure it's accessible.
Yeah, that's great advice. Really for any new market tax credit project, the investors, the CDEs, everyone's going to be asking for that information, and making sure it's all lined up is really important. So, on the project side, we often see that the confusion around eligibility that we've been talking about a little bit, right? Okay, well, I already mapped my project; it's not in there. So, what are the most common kind of misconceptions you encounter, and how do you kind of help a business navigate through those kind of hurdles?
Yeah, first one is just that initial reaction that you just described. Someone is curious about new markets, they pull up the map and they see that their address just doesn't sit in a qualified track, and they just kind of let that be the end of the road. I think that's why it's important, as someone who is new to the new market tax credit transaction industry, does a little bit of searching to make sure they understand kind of what they're stepping into. And sometimes that involves reaching out to a third party who's used to working in this space. And so here at Bekaert, all of us have depth of experience. And so when people reach out to us, we can talk through these secondary ways of still keeping the idea of a new markets deal alive. But I would say that location, it's always important to understand all the nuances of your location. Because even though your transaction might not be sitting in a, what do we call, a minimally or eligible census tract, we want to see, are you in this little range where you're not eligible through the traditional kind of geographic based alignments, but could we consider targeted populations up until the point where your qualified census tract is actually too high on the income limits? So one of the things for targeted populations deals is we kind of have to be in that middle band where we're a little too economically robust for the core geographic qualifications, but it can't be so robust that it exceeds the ceiling limits for a targeted populations deal. And that ceiling limit really is 120% of the AMI. If your census tract shows that data point at 120 or above, you are now no longer eligible for targeted populations as well. The next point of consideration is really, what is the route by which you're going to take advantage or utilize targeted populations? And there's three primary tests for this. One is the ownership test. By regulation, or at least 50% of your owners considered to be members of low-income households. Second test is revenue, also called the customer's test, where again, the question will be asked, are you generating more than 50% of your revenues from low-income households? And the third one is employees. And this one has a little bit different threshold. And the idea is, are more than, by regulation, more than at least 40% of your employees members of low-income households? I've said regulation, though, very intentionally, because that's kind of the minimum amount that was established through Treasury regs. The bar, though, has been raised a little bit further beyond that 50-50-40 to more like 60-60-60 when the CDEs are evaluating. Again, because of that idea of competition. The CDFI fund has basically challenged CDEs and required them to say, if you want to do targeted populations, that's fine. But we don't want you to scoop by with a minimum amount of percentages here. We want you to be elevated. You need 60% of your owners to be low-income households. You need 60% of your customers to be members of low-income households. And you need 60% of your employees to also be members of low-income households. So it raises the bar. So again, you need to have access to that good information so you begin testing. But here's my analysis on those three routes. The owners should be the easiest to qualify because it theoretically be the least amount of people that you need to understand their household income. But it's just not very common to find low-income enterprise or enterprises that are in these census tracts that are owned or controlled by low-income persons. I personally have not closed one of those transactions. The next up is customers or your sources of revenue. New markets will require someone who uses this route to understand the household income of their customers. Depending on what you're doing for your transaction, that could be a very uncomfortable ask, and your customers might just refuse. But depending on what you do, you might already have that information collected on behalf of your customers. So it's just good to understand the information that you already have access to when we're thinking about targeted populations. Finally, though, is that employees test. I would say this is the most commonly used route to qualifying for targeted populations because it balances that idea of information the sponsor has versus the amount of information that you're going to be requesting from other persons. And so if owners has the least amount of people you need to qualify their household incomes and customers has the most, employees fits in the middle. And it generally skews more towards the scale of owners. But we talked about like you've got to be in the right area. You've got to understand which route you're going to go through. But then you really need to understand how are you going to actually document a person's eligibility via their low-income household. And it is tested on a household basis. So if you have an employee who also has a spouse or maybe an older child or a different generational household member who makes income, all of that income needs to be considered. And because of that, New Markets has been pretty rigid in what it will accept as documentation for purposes of compliance. A lot of people will say, hey, all of these kids that we're serving go to schools that have 100% free or reduced lunch. That should be enough to prove that these children we're serving come from low-income homes. And unfortunately, that's just not accepted in New Markets. What we do see is that the industry has come around and accepted HUD home income forms. So the client or the employee would fill out their household income and insert it on that form, or providing their household 1040s as well. Those are good, acceptable ways to document the actual low-income household status of your employees, customers, or owners. But this isn't always straightforward, and there's always complications. And one of the main complications, let's say just for the employees test, is we're testing people at the time of their hire. The goal of New Markets is not to keep a low-income employee who's in a targeted populations deal at a low-income wage. We do want them to accelerate, to grow their wages, have economic and familial success, and the household income rises. And if that happens, you might think, well, that's going to put our qualification at risk. No longer are we 60% or more. Well, we test the household income at the time of hire. So if you've had someone who's worked for you for 2 years, you're going to be able to figure out their household income pretty easily. But if that employee has been with you for 10, 15 years, it's going to be that much harder to figure out what was their household income back when you hired this individual. So no matter what you pick, employees, owners, customers, you want to start early. Because what if you find out your records are incomplete or you need to collect a little bit more, etc.? You want to give yourself that time. And that time will allow you to have a more confident answer, a more responsive answer whenever the CDEs and the investors come to the table and say, hey, we think you have a good deal here. We want to commit, but we want to understand really how you're going to keep us all safe in the compliance game. So I would say getting to that compliance game, Jason, and how you go about it, it is the big game. It is the big event in these targeted populations deals.
Yeah, that's spot on, Joe. And when we talk to CDEs that are looking at these transactions, they want to know what they're going to have to do, right? And they want to know that the business is got their ducks in a row and is able to provide all the information necessary.
Yeah.
So I think that's all spot on.
And real quick, some CDEs just get anxious because they themselves don't have a lot of muscle memory for targeted populations.
Yeah.
So if this is the route for you to get your deal into compliance and into a competitive position, you want to make sure that you are presenting yourself as strong as possible so that you can lure as many CDEs to your transaction as possible.
Spot on. Yep. So let's kind of shift a little bit to those CDEs a little bit and talk about impact and kind of the stories that these transactions are going to tell. when a project is designed specifically with these targeted population deals, how do you kind of define that success beyond the financial metrics, and what does that meaningful impact look like in practice when you're doing one of these target population deals?
Yeah, I think because your underwriting from the beginning was focused in on people, my mind for this answer always goes to people. At the core of this transaction, what was the service or outcome they needed to improve their own life outcomes or the outcomes of their house, the family and the household they live in? So when I think of a deal, is this a deal about getting people more services? Do we need more healthcare, daycare, access to food distribution? Or is this a deal that's more about just creating a new source of employment for the low-income persons of that area? These are important questions, and I think that's the true metric of how successful these deals are. Are we producing the number of early childhood education spots that were promised? Are we distributing as much food as we hope was possible in this site? All of those things, are we achieving those, and we just happening to be doing it through the targeted populations route? I think that's the best scenarios, where you hit your core need outcomes and you just happen to have figured out how to use targeted populations to get there.
Yeah, absolutely. I think stories and the story that you're telling is what the CDEs ultimately want to see to give out their allocation. We talked a lot about the challenges of using targeted populations, but ultimately at the end of the day, if you've got the story, if you've got the needs assessment and the improvements in those communities, that those outcomes, I think you're going to get a lot of CDEs interested, regardless if you're using targeted populations or not. Is there a recent example of one of these projects that you successfully used the target populations to work on, and what made it work, and what lessons kind of came out from that project for you?
Yeah, we were really lucky that we recently had a client in Alaska who was putting up a youth services facility. So this is a nationally known organization, but the local chapter in Alaska had just outgrown their current spaces. And so they wanted to put up a new facility so that they could expand the scope of their before and after school programs, so that kids would have more safe places to play and spend their time outside of the normal hours of school during the school year. And then also to have a place to go during the summer for kind of healthy, productive programming that's going to keep these kids engaged and kind of out of trouble during the summertime. But Alaska is a bit of a unique place in that it has these geographically gigantic census tracts that have relatively low populations inside of them. So only a handful of people who have higher incomes can really throw off the census data for these regions. And I think that's what was at play with our client here in Alaska, where there certainly were a lot of low-income persons and families that needed access to this sort of youth services facility, but the geography simply did not support it via closing the traditional route. So we worked with an investor and the Alaska CDE very closely to understand, hey, we want to understand your commitment to the deal. If we want to do this deal, we have to go to targeted populations. Here's the information we have. Here's the information that we're working on. And it was a long process, but it was an open communication process where we worked with the CDE, we worked with that investor. So everyone was understanding what was the level of compliance, how were we documenting this? And it was a conversation where they would say, hey, we would prefer you have XYZ additional information, or we prefer you have this cushion above the 60%. And so we worked through it. We gave ourselves the time to do this. And at the end of the day, we were able to fund a new market tax credit transactions for a nonprofit service provider in a census tract of Alaska that didn't qualify under the original kind of geographic qualifications. So it feels like it's been a success. The sponsor was ecstatic to get the extra support to wrap up construction. And we're hoping to get some ribbon cutting announcements here, in the near future, showing that this site is open and ready to go for the local kids.
Yeah, that's really exciting. That was a great project, and kind of really leads me into my next question. We know that these new market deals have lots of moving pieces, and they require a lot of collaboration across stakeholders. Anyone that's done one of our new market deals has been on a call with 30 individuals. How do you and I kind of typically work together and ensure that these deals are structured to kind of meet compliance needs while still driving those community outcomes? I think you talked a little bit about the communication that goes on there. I think when we closed the last deal, I think it was just a lot of conversation, right? Going back and forth on kind of what items the nonprofit business who is really doesn't deal with these new market compliance issues very often, making sure they understand everything there. So anything you kind of have to add on kind of the communication piece that kind of goes on during these target pop deals?
Yeah, I would say it's been nice that whether it's targeted populations as a technical issue or any other kind of technical issues that can arise out of new markets, and we both know there's a lot of those, having that communication is important, but then also having some resources that allow people to kind of do their own homework or check the diligence and the documentation that we're providing. So we work with our customers to establish, whether it's on Smartsheet or Dropbox or Box.com, any of those file sharing organizations, we like to come up with an organized system so that the CDE and the investor can also peruse the backup on their own terms. So they're not always just waiting for us to kind of fly in and drop a nicely packaged set of information. We're working with them live time. They're seeing the information when we're seeing it. And I think it, one, establishes a lot of trust because there's a lot of transparency. And then two, I think it speeds everything up when they're not waiting for us to fly in with a pretty package. They can come in and work live time. If they've got midstream questions, there's nothing preventing them from asking it. I think it accelerates things. So I think timely communication, systems that keep you organized, these are the things that help these always complex transactions seem a little bit more manageable.
So kind of moving along here, with the policy shifts and legislative updates always changing, noting the new market tax credit did receive permanency in the tax code recently. That's permanently in the tax code, but nothing's really permanent nowadays when we think about the legislative environment and what we're up against. What should listeners kind of keep in mind when they're planning future new market tax credit projects, especially those focused on using target populations?
Yeah, it is a complex environment. Like you said, new markets was just made a permanent fixture of the tax code. So it has relieved some industry confusion, is one word to put it, about what is the future of our program. It's permanent now. So we know that there is a program. The next level of questions come up of, well, then maybe what will a given administration want out of the program? And that's really hard to predict. Some administrations might want outcomes that look like blue, and some administrations might want outcomes that look like red. I tell my clients, just keep doing what you're doing because it's gotten you this far. And we will figure out a way to make sure that we're communicating to those interested in red what they want to see and those interested in blue what they want to see. I think the thing about new markets is when you come into it, make sure you understand, and your consultant, your team, whoever you're working with, shouldn't be shy in telling you that it's going to be complicated. You need to be patient. You need to have time. This isn't something that you can just do in a couple of weeks. And if that is your frustration with new markets, it's going to be a frustration because it's just going to take some time here. When you think about your future project, the theme of time keeps coming up. Don't wait till you need financing in 3 weeks. Don't wait until you need financing in 3 months. You should be working with the new markets industry as far in as advance as your effort allows. So if you're reaching out to a consultant or a CDE or an investor 12, 18 months ahead of time, that's not too early per se. That's when these conversations start happening. So if you're thinking about new markets, you should start talking to people in the industry as well to get early feedback and understand kind of what lane or channel you're kind of looking at right now.
Yeah, and it really, before we kind of wrap up and get to kind of final thoughts here, really seems like a perfect kind of segue into this is probably a targeted populations deal, probably best case is to find someone that's done it before and utilize a consultant to get you to the end. Is that a fair statement?
Yeah, I mean, new markets is always complicated. And then when you add on targeted populations, it just kind of adds a whole nother layer of complexity that, frankly, not a lot of people in industry have a lot of muscle memory for. So I think it's important to find someone who has done this recently, and is also aware of experienced third-party service providers like experienced accountants, experienced attorneys who understand this space as well. The last thing you, as the sponsor or the quali B, want to be doing is paying someone on their learning curve. You don't want to have to pay for that because, attorneys are skilled professionals and they come with skilled professional billings. Well, let's find the ones who have already done that education so that we save you some dollars and some frustration.
All right. Well, thanks, Joe. I really appreciate your expertise here, and I know our listeners got a lot out of the targeted populations conversation here. It's pretty clear that new markets are already complex, and targeted populations can make it more complex, right? But it's also a really powerful tool when used kind of thoughtfully. So we hope today's conversation helped shed light on how to approach these deals with confidence and clarity. And that's it for the episode of the Tax Services Podcast. If you have any questions, ideas for future topics, we'd love to hear them from you. Thanks for listening, and we'll see you next time.